Good evening, everyone. Welcome to our Irvine Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking time out of your busy schedules to join us for tonight's class. In case you haven't joined one of our classes before, we typically teach our Irvine class 4 to 5 times a year. And what you're going to learn a little bit more about is about kind of the home buying process, programs, things around credit, really to help get you on the path towards homeownership. So whether that's this year or next year, just want to provide all the information for you to help make an informed financial decision in your future. We're lucky enough to partner with UCI alums. So many of you are joining tonight's class because of our UCI alum partnership. We've been partnered with UCI for the last probably five years. Really excited to be able to help serve our communities here in Orange County. You may be joining us from other parts of the West Coast here, so thank you for joining us. Most of what we talk about tonight is going to be California-based information around home buying, and our classes are very interactive. So we encourage you to ask questions as I roll through tonight's content. So we'll have some Q&A at the end of tonight's class, but we'll also be taking questions as we roll through various slides. A little bit about me. Again, my name is Jason, and I'm an originator, but also branch manager. So not only do I teach classes, but I also work one-on-one with clients and some of our business partners in our communities. And I specialize in first-time home buyer programs. So what we do is we do a lot of our educational classes like this, and then we help kind of guide our clients down the path towards home ownership. Right, so here's some of our talking points tonight. So we're going to look a little bit at the housing market. We're talking a little bit about what's going on with interest rates, what's going on with housing appreciation. We're going to spend some time looking at a budget analysis. There's, buying really makes sense for us when we compare renting versus buying. We'll talk a little bit about credit. How do we get ourselves in the best possible credit position to be able to purchase and be able to purchase smart? We'll look at student loans, different programs that are provided to you as first-time buyers. We'll look at some of the documentation we typically need to go through the buying process. We're also going to talk about assistance programs for first-time buyers. We specialize in helping first-time buyers with assistance towards down payment and closing costs. So you'll learn a little bit more about that tonight. In fact, there's a new program that is going to launch this month. You're going to be one of our first classes that we're going to kind of go a little deeper in and talking about this assistance program. So we'll share that with you later on tonight. And then we'll kind of wrap up tonight's discussion looking at the process of buying a house, as well as what does a consultation look like. So when we sit down for a one-on-one over video to design a home buying plan, what that might look like for you. And then really that'll take us all the way to getting pre-approved for our home purchase. Okay, so those are tonight's discussion points. As we start tonight's class, and we kind of want to think about, first of all, this is going to be probably one of the biggest investments we make in our financial futures, or at least our immediate financial futures, because purchasing a home, it does provide some phenomenal opportunities for us, but it's a big financial commitment at the same time. So for all of you that are taking time out tonight to kind of just invest and really understanding more about this is huge, and it hopefully sets you on a path for success with home ownership. There's some great benefits that come along with buying a house: stability in your housing payment, growth in equity of your home, appreciation is what that would be known as. That's the difference of how much I owe on a house versus what the market value is for my home. This is an asset that you can potentially, build into your financial wealth, and also have the ability to pass along the asset to heirs of your estate. And there's still some great tax benefits that come along with owning a home. So you can still potentially deduct interest on a home. So a lot of great things happen with home ownership. But I think on our first stop in going through tonight's discussion really needs to be centered around our budget, because the primary reason for most of our first-time home buyers electing to purchase is because they want to create stability and affordability in their housing budget. We understand that things are, more expensive today, right? We're in a high inflationary environment, and so things are just more expensive, and home ownership or just housing in general is one of those things. So let's first talk a little bit about the budget and kind of how we design this. So this is our rent versus buying calculator. And what it's going to do is going to show us our current rent situation versus what it could look like as a buy situation. So I'm going to kind of put a what if scenario together for us. All of our tools and resources from tonight's class are going to be sent back out to you tomorrow morning. So things like this website, the link to it, which is at Freddie Mac, those will all be available to you so you can run through these exact same scenarios yourself. Okay. So I'm going to go ahead and just put some data points in. We're going to talk through it. And then, some of these might be a good match for you. Some of them, you may have higher costs in your housing. So, this will, once you get the material, allow you to do your own calculations. So let's make some assumptions in our calculation here. I'm going to go ahead and start off with the rent tab here. As you can see here, we're going to assume rent of, let's say, $3,000 a month. And I'm going to put monthly renter's insurance of estimated $15 a month. And then the assumption is that we're going to see our rent increases by about 3%, which is pretty fair. Across California, obviously, we see rent prices go up even higher than that in some cases. And then on the home purchase side, I have in here a $600,000 purchase price. That obviously can look a lot different depending on where you're going to purchase, whether you're in Irvine or maybe you're in the Bay Area or maybe you're in LA County. That purchase price will obviously change and your purchasing power will look different in those different areas. But let's say $600,000. The minimum down payment is 3% when we purchase as a first-time home buyer. You're going to learn a little bit more about that in our loan program segment of tonight's class. Property taxes on a $600,000 house are about $7,200 per year. And then when we purchase a home, we also have homeowners insurance. That's going to insure the house. Sometimes you can have add-on coverages like flood insurance, maybe some additional fire coverage if necessary, based upon where you're purchasing. And then we want to factor in maintenance costs. And so for this example, we have $700 for maintenance. Of course, if we purchase maybe an older home, there might be more maintenance cost with that. And then loan information will include the type of loan we're doing. So we're going to generally have a conventional or an FHA loan. For most of our first-time buyers, it's going to be a 30-year fixed mortgage. And then we're going to plug in an interest rate. We're going to talk about interest rates in just a bit because they've been kind of all over the board here recently. I'm going to put in 6.75 as our interest rate today. And then for origination charges, that's generally going to be what a consumer is going to pay in costs for their loan. Usually there's going to be things like processing fees, underwriting fees, credit report fee. Those all come under origination charges. Now, for those of you that are joining us through our UCI alum partnership, we have a fantastic discount program. So you actually get $750 off of our origination charges. So that's an awesome benefit with alumni. This next section is called discount points. What that means is that gives you the ability as a buyer to potentially pay more in closing costs to help reduce the cost of your interest rate. Generally speaking, 1% of your loan amount is going to be one discount point, which will usually lower your interest rate about 0.25%. So if my rate is 6.75, but I'm going to pay 1% in discount points, maybe that lowers my rate to 6.5%. Everybody's loan program is a little bit different based upon credit score and the characteristics of the loan. And then other settlement services are going to be things like title and escrow fees, sometimes transfer charges. They'll all be encompassing in the overall closing costs of your home purchase plan. So when we think about saving for our home purchase, we're going to have to set aside money for our down payment, which in this example is 3%. And then we have to have money set aside for closing costs. Usually closing costs can be anywhere between 2 to 3% of your sales price. We're going to talk a little bit more about that in just a few minutes. All right. And then our next tab we're going to look at is around kind of other assumptions. So we're going to assume that our home will hopefully appreciate 3% over the time of ownership. Now, in our model here, we said that we're going to be in the house for 7 years. The selling cost tab or section is basically how much is it going to cost me as a seller when I eventually sell my home. Now, good news for us buyers is when you have a realtor that represents you as a buyer, their commissions are not paid for by you. They're actually paid for by the seller. So we always encourage our buyers to take advantage of the realtor resources because they're your advocate to help negotiate the contract, to help really find the right home that works for you. State and federal taxes, we want to factor into our model, and then a savings rate, which we just put at 1% just for tonight's discussion. So what this does is it stacks up our rent, continuing to rent at $3,000 a month, which is versus what it could look like on the buy side. So when we look at the payment difference, it's a big difference. It's $3,000 in renting versus buying at $5,100 per month. Now, those aren't obviously an apples to apples comparison because of all the fantastic benefits that go into owning a home. But purely from a savings perspective, over the 7 years span of time, assuming some of that, the conservative appreciation rate, we're looking at an upside of about $47,000 in owning a house versus renting. Now, if you're paying a lot less in rent, then there's not going to be as much savings, of course, or if you're looking to buy a higher priced home, that might diminish some of our savings. But ultimately, when we think about owning a home, it's more to it than just saying, hey, you know what, I'm going to go up from $3,000 to $5,000 in a month. It's the opportunity to have that asset that hopefully is going to work for me in home ownership. Okay, so that's the buy versus rent example. Again, I'm going to share all this material with you tomorrow morning. And then, I would really encourage you to kind of take some time to go through your own rent versus buy calculation to see what that looks like for your household budget. Now, as part of our consultation, which is something we would encourage you to connect with us on at some point, we're going to go through a rent versus buy or just an overall budget with you as part of your consultation when we design home buying plans for you. Okay, so let's now talk a little bit about the housing market. So a lot going on with the housing market. I'm sure many of you on tonight's call are kind of paying attention to what's going on with certain properties that you're seeing. You're probably seeing those homes stay on the market a lot longer. As this slide shows, median days on market is like 68 days. I think if you were to back up 6, 7, 8 months ago, and this chart really reflects it, you see the days on market significantly lower, especially going back into Q2 of last year. But what we've seen now is interest rates have kind of come up. They settled back down. They've kind of gone back up a little bit with some more inflationary concerns. So, maybe not as many buyers out in the market right now. Sellers are having to make price cuts on homes. Those homes are sitting a little bit longer. But all of that being said, it still presents a fantastic opportunity for buyers. It's still kind of more of a buyer's market, less competition on the market. And when we have homes that are sitting on the market, 2 or 3 months in some of our communities, does present an opportunity for buyers to be able to negotiate a little bit better on a particular property. So, as we're looking at going into now the more kind of busier months, if you will, spring and summer buying months are going to be, they're expected to increase. I believe the numbers I saw over Q4 was like a 25 to 30% increase in sales activity going into April, May, June. So that's going to be a huge uplift. Of course, some of that's just seasonality in the markets, but nonetheless, I still think there's a huge opportunity for buyers to be able to find the right home that fits their budget and now maybe have a different vantage point to things. Because over the last 2 years, especially during the pandemic, it was very difficult for first-time buyers to negotiate reasonable prices. Those same homes that a lot of buyers purchased during the pandemic that maybe were list priced of $500,000, they had to bid those homes up to $550,000, $575,000, maybe $600,000. And so this market looks a lot different. That same home, maybe now that sells for $500,000, maybe that seller's willing to take a price cut, or maybe the seller's willing to help negotiate and support you more with closing costs because there isn't that demand. That house has been staying on the market. The house maybe has been on Zillow for the last 3 months. So I think that's where the opportunity lies for a lot of our buyers that are interested in getting into the market. Now, what is changing buyer behaviors is, of course, interest rates. Interest rates have kind of seen peaks and valleys, especially over the last, I would say, 3.5 years. This chart kind of goes out over the last 25 years, but I think we need to probably pay more attention to what do we see in the last 3 years. This line represents kind of the start of the pandemic and what we saw with interest rates bottoming out to 2.6 to 2.5%, somewhere in that area. Since Q2 of 2022, we've seen interest rates kind of gradually go up, as what this slide indicates. The line that we're looking at is the blue line, which is the 30-year fixed mortgage. We saw them peak right about in November. We've seen them settle down. They've kind of ticked back up. Our high rate here actually was probably closer to like 7.25%. Average rate's probably closer to 6.75 to 6.8 today. What's driving a lot of the behaviors and interest rates right now is really the concern around inflation, the cost of everything, right? The Federal Reserve is trying to manage inflation with hiking of interest rates, and that's what we've seen as of late. So the real concern right now is, where does the interest rate increases stop, with the Federal Reserve. So the next meeting, I think, is like 3 weeks away. And so I think everybody's kind of watching to see, is it going to be a 0.25% increase? Is it going to be a 0.5% increase? So we're going to be really watching that carefully. The inflation numbers that come in, and we kind of watch this really closely in working with our clients that are out home shopping right now, or maybe in escrow on their home, is just, kind of watching what data is coming in, because that is moving the markets. Markets moved a little bit today. We saw the rates move about 0.125%, which is not a huge movement, but there's things that are little subtle changes that can change the interest rate offering for a consumer. So kind of as we go forward into the spring and summer buying months, we're going to have to really pay close attention on what interest rates are going to do. Hopefully they will settle down a little bit. The other side of things are people are talking a lot about recession, and where does kind of the increase of rates, the pace that what we're on with the Federal Reserve increasing rates, does that maybe push us into a recession? And recession could lead to lower rates. So it's kind of a lot to be determined right now at this point. But I think as buyers, we need to understand what our options look like. So if we do try to take those steps towards homeownership, we know what our buying budget looks like, right? Now, interest rates are not all the same for every client that's purchasing a home, and they vary. They're based upon credit eligibility. If I have a 740 credit score or better, I'm going to have access to the best available interest rates. My loan product can change my available interest rate, how much I finance, what my down payment is. And as I mentioned earlier, the cost of obtaining interest rates can change. So if I decide to pay additional cost, I may be able to bring down my interest rate to a lower level. And the last component to interest rates, or the characteristics that can make up an interest rate, is the term of my loan. So if I elect to take a lower term, that could potentially bring down my interest rate. Now, for most of our first-time buyers, I would say 95% of first-time buyers, we're going to go for a 30-year fixed mortgage product, just because it's going to give you the lowest available interest or lowest available payment option, but also it's going to be more predictable, right? It's a 30-year fixed mortgage. We know exactly what we're going to pay on a monthly basis. Now, what goes into interest rates, and probably the big variable, is credit, right? And, so what we're going to do is we're going to talk a little bit about credit and how to maybe maximize our credit, because we want to ensure that as we're designing a home buying plan for you, that we're giving you the best available options based upon where your credit lies. Now, the FICO score calculation for credit is here on the screen. And many of you probably monitor your credit, whether through Credit Karma, Experian, Equifax, or TransUnion. And those are all great tools. I would, just let you know that those tools that you use are consumer tools that are primarily used off the credit card model. So when we apply for a mortgage, of course, we're going to be using the mortgage model. And that's what we have here when, we kind of go through our classwork with our clients. And so this is kind of the weighting of the score calculation. 15% of it's going to be how long I've had credit. So the more mature my credit file is, the higher my potential credit score could be. 20% is going to be how much new credit I have in use. So if I'm, adding new accounts to my credit file, or I'm trying to apply for new debt, and that's going to be really around hard inquiries. So if I do a hard inquiry, that can have an impact in my credit score. Now, there is a rule in credit for auto financing and mortgage financing, which states that if I apply with, say, a mortgage lender today, that's day one, I have a 30-day window of time to apply with as many mortgage lenders as I want. And it's the equivalent of one credit inquiry hit to my score, basically. Now, the good news is with our team here, when we start our home buying process and design home buying options for you, we actually use a soft credit score to begin the process. So we'll design financing options around that for you. A soft score does not impact your credit score at all. Okay, 30% is going to be our credit utilization, or how much we owe on our revolving debt. Simply put, is that if I have a $10,000 credit limit and I have a $5,000 credit balance, my utilization is at 50%. Ideally, we want our utilization below 10%. So if we're running at 70, 80% because we have a lot of holiday expenses that are still on our credit cards, and maybe we're only paying the minimum payment, we want to try to do our best to get below 50% utilization as a starting point. And then kind of the big goal would be to get below 10% utilization. 35% is going to be our pay history. If you had any past challenges with maybe making bills on time, they're usually rated in 30-day lates, 60-day lates, and then 90+ delinquencies. So the more severe the delinquency, the more impact you're going to see on your credit score. Usually, if I've had a late in the last 12 to 24 months, that time of a period of time is going to be the most impactful to my credit score. Now, every loan program has a minimum credit score. So FHA loans are 580. The conventional product, which is going to be, you probably heard about Fannie Mae, maybe Freddie Mac, that minimum credit score is a 620. For our veterans, for the VA product, it's a minimum score of 620. And then you're going to learn a little bit more about the first-time homebuyer program through the California Housing Finance Agency. That has a minimum score of 640 for FHA, 680 for a conventional loan. Now, utilization is probably one of the biggest impact or maybe opportunities, if you will, with all of our clients, not all of our clients, but most of our clients that we meet with throughout the day. And with utilization, there's ways to manage utilization to help maximize your credit score. So one of the tips I want to share with our class tonight is, how to kind of take a look at your credit cards so you're getting the best possible utilization. So if you look at your credit card statement, there's a billing cycle date and then there's a due date. And the end of the billing cycle date is when your credit card issuer sends out your balance information to the credit agencies. So TransUnion, Equifax, and Experian. What I would, the tip here is that I would encourage you to try to pay down or pay off your balances before the end of your billing cycle date. Because if you do that, that balance, if it's $0 or $500, whatever the amount is, that's what gets reported out to the bureaus. So a lot of our clients, when we initially meet with them, they're in the habit of just paying on their due date, which is perfectly fine, but you're not maximizing your credit utilization. So if you can kind of change that payment frequency and pay before the end of the billing cycle date, you're going to get a much improved credit score. Account closure is another thing I just want to kind of give you guys some tips on. Try not to close revolving accounts, because when you do that, there's two things that can get hurt. One is your credit utilization can go up because you have less credit available. And secondly, your length of credit can go down, especially if you have more mature accounts that have been longer standing on your credit bureau. Now, as lenders, we take 3 scores that we look at. We look at the TransUnion, Experian, and Equifax score. We take the middle score of all 3 of those. Now, if you're applying with a co-borrower, we're going to take the lowest middle score of the co-borrower. So what that looks like is that if I'm a 740, 720, and 700, so my middle score is 720, but my spouse has a 700, 680, and 660, we're going to use the 680 score for qualifying for the financing. So just something to kind of be aware of when we, when we're looking at different financing options for you. Now, negative items on our credit report, as I mentioned earlier, if you've had some past challenges, the impact, like late payments, for example, will be in the first 12 to 24 months of that since that event. If you've had hard inquiries, late payments, now the time at which they're going to stay on your credit report is shown here on this matrix. Okay, so what we're really looking at is things that have occurred in the last 12 to 24 months. Now, I'm glad we kind of put this on this slide, which is medical debts. There's a new kind of credit rule that's coming out. If you've had medical collections, they will no longer appear on the credit report after, I would say, Q2 of this year. So if you've had some medical collections that didn't maybe just get paid by your insurance company, perhaps, those should not be reporting on credit reports after probably Q2 of this year. Okay, any questions on credit? Because I know that's a big topic for a lot of our classes. Is there any questions I can help answer around that question? Because we're going to move into student loans in just a bit, and that usually sparks some questions as well. But I want to see if there's anything I can answer for you on credit. Okay, all right. Well, we can always come back to that topic if necessary. Let's talk about student loans. I probably get 4 or 5 questions a day on student loans. So I think it's super important. Most of our clients that we work with do have student loans. That's just the reality. All of your student loans right now, especially federal debt, is in forbearance right now as part of the CARES Act during the pandemic. I believe they're set for repayment in July, if I'm not mistaken. Now, even though those loans are in forbearance, as a lender, if we're looking to qualify for our financing, we do have to count some minimum payment against what we call the debt to income ratio. So it has to be included as an obligation. There's a couple different ways we look at that. If you're doing a conventional loan, we take as a default 1% of the aggregate balances, and that's what we use as the monthly payment. However, if you're in an income-based repayment amount on a conventional loan, let's say it's $50 a month, that's the payment we'll use for qualifying. And so we have an example on the screen here. So you can see where we took $75,000 in student loan debt with a $250 payment. If that's the payment that particular client has, that's what we use for qualifying. For FHA loans, which we're going to talk about in just a minute, FHA loans, the default is 0.5%. And if you're entered into an income-based repayment that's more than 0 per month, then that's the amount that we can use for qualifying. So some of our clients that we're working with maybe graduated during the pandemic. With that, they've never had a chance to, have an income-based repayment. So if they're looking to qualify for mortgages now, then we would have to have them enroll in some type of income-based repayment amount, or we would have to count that 0.5% for an FHA loan or 1% for the conventional loan. Okay, so that's a little bit about student loans. Let me just answer a quick question that just came in. And the question is, how does leasing a car versus purchasing a car affect credit? So there's obviously 2 ways to buy a car, maybe 3: pay cash for the car, do an installment loan, or a lease. Leases or installments really aren't going to influence the credit score one way or the other. Okay. And another question is, what's the best time to pay my credit card in order to increase my credit score? I know you said before the billing cycle. Is that the same as the next closing date listed on my statement? So yes, so that's exactly the tip I was given. So the closing date is going to be the same thing. So if your closing date is the 4th of the month on that credit card, but your due date's like the 10th, you want to pay off that credit card before the 4th of the month. All right. Okay, so just to kind of just wrap up on student loans. So again, if it's in forbearance, maybe it's in deferment, we still have to count a minimum payment for the qualifying. And that's something we can work with you during your consultation, and kind of take a look at how it's reporting to your credit report, and kind of give you some guidance on, what documentation we think we would need to help you with your pre-approval. Now, there's various loan programs, as you've heard so far in tonight's class. And what I wanted to share with you is kind of the 5 of the core programs that usually we're helping most of our clients in our communities with. There's the conventional loan that you've probably heard a lot about. Those are Fannie Mae and Freddie Mac loans. It's a minimum down payment of 3%. All the way up to a loan amount of $726,200. Now, if you're buying in Orange County, LA County, even in the Bay Area markets, some of the higher cost of living markets across California, when you finance more than $726,200, that minimum down payment now goes from 3% to 5%. And that space above the $726,200 is basically a high balance conventional loan. So those loans can look a little bit different from an interest rate perspective, and maybe have some other criteria, but ultimately as a first-time buyer, that down payment will just elevate from 3 to 5% if we're going to go to the higher loan amounts. Every year, Fannie Mae, Freddie Mac, the FHFA updates the loan amounts, and we usually roll those out around October of the year. These are the new loan limits that have been put in place, and they're basically adjusted every year based upon cost of living. For FHA, you can go up to a maximum loan amount of $1,089,300, but the down payment doesn't change. It's still 3.5% regardless, even though if you're going up to those higher loan amounts. Now, for those of you that are joining us, maybe or joining us and looking to purchase in Riverside or San Bernardino County, that loan amount is going to be maxed out at $726,200 in those communities. Same with like Kern County, for example, or if you're maybe going into some of the valley areas. FHA loan limits can look different in different counties, especially if we get into maybe lower cost of living counties like the Central Valley, for example. I'm going to do a comparison on conventional and FHA loans in just a second, but just to kind of flash back to what we talked a little bit about on the credit side. So keep in mind, conventional loans have a minimum score of 620, where FHA have a minimum score of 580. Now, for our VA loans, those are for our veterans that have served and have eligibility under the VA product. So you can basically do a VA product with no money down. And so that goes beyond a loan amount of $1 million. Okay, in fact, we can go up to like 2 or 3 million on the VA product. USDA loans are going to be for clients that are looking to purchase in more rural areas. So if you really want to live, maybe I think Joshua Tree, for example, is a USDA eligible market. That's a 0 down product. Goes all the way up to $1,089,300. You just have to meet the geography specifics, as well as there's income limits around that product. And then there's jumbo loans. Usually those require a minimum down payment of 10 to 15%. And with those products, It's not just only saving up the down payment and our closing costs, so that 2 to 3% of our purchase price. Jumbo loans also have a thing called reserves. And what reserves are, it's the assets that we have available to us as a home buyer after we've contributed our down payment and closing costs. Usually it's the equivalent of 12 months of your monthly payment. So if my monthly payment's $6,000 a month and it's a 12-month reserve requirement, that means I would need an additional $72,000 in assets. Those assets can be in 401ks, 403bs, brokerage accounts. So it's just additional assets that we have left behind. Now, most of our first-time buyers, that's not going to be the product because that's usually the second or third home purchase. But I think it's important, especially as we're looking at maybe some higher cost of living markets, if we're trying to finance more than $1,089,000, to understand a little bit more about what our options look like. Okay, and before we leave the product screen, you may have heard about some of the federal government changes in the cost of financing. So the funding fees for VA loans were reduced down just last week. We've implemented that as an organization. So there are cheaper financing options for VA loans. And for FHA loans, there's also lower mortgage insurance. We haven't updated our slides here yet, but I'll kind of give you guys the manual calculation on that as we go through the PMI explanation in just a second. So what I want to kind of just go through now is just to do a side-by-side comparison of what we call as PMI, looking at conventional loans versus an FHA loan. And why that's really important is because when we put less than 20% down, we're going to have PMI. And PMI is basically a protection for the lender in case of default. FHA loans, it's a requirement regardless if you put down 3.5% down or you put 20% down. So let's talk first about conventional PMI and what that looks like. So there's various options on how you pay conventional PMI. There's monthly PMI, and so that's factored into your monthly payment. You can basically split the PMI and pay some of that up front. You can pay some of it in your monthly payment. There's single premium mortgage insurance, where basically you're buying out the entire term of the mortgage insurance. That doesn't happen a lot. There's also lender paid mortgage insurance where you elevate the cost of your interest rate to buy out the mortgage insurance. The more common option is to do the monthly MI. And the reason why most clients do that is because it does have a cancellation option. When you have at least 2 years in your loan and 20 to 22% equity, you can apply to have that mortgage insurance canceled. Now, mortgage insurance is not the same for every consumer when it comes to a conventional loan. So it's based upon credit score, how much the down payment is, and then how much a buyer finances. So let me show you an example of PMI for a conventional loan down here at the bottom of the screen. So if I finance $450,000 and my credit score is 740 and I put down 3%, my PMI is going to be about $183 a month. Okay, so that's what that would look like. Now, if my credit score is a little bit lower or I was putting more money down, then that mortgage insurance amount would change. Now, FHA mortgage insurance works a little bit different. And with FHA mortgage insurance, there's monthly MIP and there's upfront mortgage insurance premium. Now, just last week, we announced the change to the MIP for FHA loans. So they actually brought the MIP down from 0.85% down to 0.55%. So we'll send you guys out updated numbers on this, but let me actually just I'm going to go kind of on the fly here. I'm going to do an updated MIP calculation for everyone so they can get a sense of what that looks like. So let me just do that. I'll just kind of verbally tell you guys what the number looks like because it's a big deal when comparing conventional and FHA. So the MIP was reduced down to 0.55%, and what that does on this calculation here is the same amount that we finance with FHA, $450,000. We still have to add on the upfront mortgage insurance premium, which is 1.75% of the loan amount. But the MIP, which is this 324, with the recent changes announced last week, it actually drops the MIP down to $209 a month. So now it's only about a $26 gap for our first-time buyers, where before, obviously $140 makes a big difference. And so, as we're moving forward with the FHA, that's going to probably be a bigger option for a lot of our clients, because not all of our clients looking to do conventional have 740 credit scores. Maybe they have 680 credit scores, and those lower scores can increase the cost of that mortgage insurance. Now, with FHA loans, the mortgage insurance is for the life of the loan. So on a 30-year fixed mortgage, a client would have that mortgage insurance for the life of the loan. If they decided to cancel that mortgage insurance, the only way they could do that would be for a refinance of the property. So they have to basically switch out of the FHA loan to a refinance. Yeah, I got your question about doing an example of $1 million loan. So for time's sake, we'll do the $1 million payment example off screen, and then we'll kind of share that with the group. But I did get your question, so thank you for that. Okay, so that's a little bit about what mortgage insurance looks like. And I think that's an important thing to understand as we kind of design your home buying plan. We're going to go through those examples during a consultation, so it's not something you're going to have to figure out on your own. I will tell you that when I talk with several clients over the course of the day, if you're doing searches on Zillow or Redfin, a lot of those mortgage insurance calculations are not accurate. They're quite inflated because they're not calibrated to some of those characteristics I shared with you, the down payment, credit score, and amount financed. They're just not set up that way. Okay, so documentation for home buying is going to be one of the things we want to kind of just spend just a brief moment talking about now, and some kind of just misconceptions that some of our buyers have around what they need to start the home buying process. Now, for a W-2 wage earner, usually we need the last 2 years of W-2s, which you just got those a couple weeks ago or 4 weeks ago, the last 30 days of pay stubs, and then we do a verification of employment during the process. For our self-employed individuals, we need a little bit more documentation. Usually we need the last 2 years of tax returns. So our tax filing is not due until April 15th. And if you decide to do an extension, it goes out till October. But the last 2 years of taxes is what we generally need. Profit and loss statement, and then we verify the business either through like a business license or maybe even a CPA letter. Okay. For self-employed individuals, you are going to need to have at least 2 years employment or 2 years having that business established. Some of our self-employed clients, especially those that had to battle through the changes of the pandemic with their business, it seems to be more favorable to have the last 2 years of taxes for 21 and 22, because obviously 2020 was challenging for most businesses. But in the calculation for underwriting, they're going to do an average of the 2 years. Okay. Some cases they'll go over 3 years if there's kind of just changes in the business. Now, for our W-2 wage earners, just to kind of just talk really quickly about some misconceptions that we hear, from clients that come to us and ask the questions around like, hey, I thought I have to have 2 years on the job to be able to qualify for a mortgage. Actually, you just need 2 years work history and or education. So for those of you that maybe just graduated from UCI, and let's say you went 4 years at UCI, you got your accounting degree, but you just started your job this year, because you have education and you're working in your field of study, that would qualify for the 2 year requirement. So, you don't have to have just 2 years on the job. And even if you transition to a new job, let's say you go to a new job, you just started that job, we can even qualify clients with just an executed offer letter, as long as we know that they're going to get their first paycheck before their first mortgage payment is due. So there's some definitely opportunities where you don't necessarily have to be 2 years on the job, or maybe you're looking to qualify with different income because you have some projected income from a new job. Now, if you're holding down 2 jobs, that's where it gets a little trickier, because you do have to be on both jobs for 2 years simultaneously. Sometimes we'll see this in the healthcare industry, where we have a client that works at one facility for 30 hours, maybe another facility for 20 hours. In order to use both sources of income, we do have to make sure that that client has been working on both jobs for 2 years, or shown a pattern of working 2 jobs in that capacity for 2 years. Okay. If you're doing side work, let's say you're working a full-time job, but you're also driving for Uber or Lyft, we can use the additional income for qualifying. We just have to show that we've had 2 years with that employment. Now, some of the loan programs, and we're going to talk about assistance programs, first-time buyer assistance programs in just a minute. If you have overall household income and you are just applying as one member to the application, the whole household income doesn't always need to be included for qualifying under assistance programs. And we're going to talk about that in just a minute. So sticking with the kind of the theme of income, I want to kind of give you a calculation that we're going to work through as we design your home buying plan. That's called the debt to income ratio. And what it does, it takes in consideration your gross monthly income versus your monthly obligations. And we look at the pre-tax income. So we're not looking at your net income. And the things that we take into consideration in the debt to income ratio analysis is your upcoming mortgage payment, credit card debts, personal loans, auto loans, student loans, like we talked a little bit about earlier. Those all get factored into the debt to income ratio. So it's simply looking at those obligations versus your gross monthly income. Now, the guidelines allow us to go anywhere between 43 to 49% debt to income ratio. But more importantly for us is designing a home buying plan that's affordable for you and sustainable, right? So even though the guidelines will allow you to go to a higher debt to income ratio, as we meet with you and figure out what the home buying plan looks like, that debt to income ratio for you as a buyer may be 36% or 35%, whatever the number looks like for you to make you feel comfortable with your home buying purchase. Here's the calculation of the debt to income ratio. So it takes into consideration the principal and interest of the loan, the property taxes on your new house, your homeowner's insurance, PMI, that private mortgage insurance, if we put less than 20% down, or if we elect an FHA loan, homeowners association dues, if applicable. So let's say that was $2,500 per month. And then we'll add in our other obligations. And let's say that was like $500 a month. So we'll take that $3,000 in obligations versus the gross monthly income. That factors out to a debt to income ratio of 35.29%. Now, in meeting with all the clients we do throughout the year, probably the sweet spot for debt to income ratio is anywhere between 33 to 36% generally. But I think ultimately it's gonna come down to where you feel most comfortable at. I have some clients that feel more comfortable at 25% debt to income ratio, or other clients that would be comfortable at 45 because they know they have some additional income that maybe I just couldn't factor into the qualifying of their mortgage. The last component to putting together our plan for home buying is around our assets for down payment and closing costs. And what I wanted to share with you now is some of the documentation and kind of how we would construct assets for the home purchase. As we know, we're going to have our down payment for savings. We're also going to have closing costs that we want to make sure that we're budgeting for. The documentation that we'll generally need as a lender is the last 2 months of statements for checking and savings accounts if you're going to use those type of accounts. Cash deposits cannot be used. So we have to paper trail and source every deposit used in a home purchase transaction. Now, if you decide you want to use, a 401k, maybe a 403b, maybe even an IRA account, those can be potentially used. We would just encourage you to talk with your tax advisor, maybe your financial advisor, if that's going to be a good, use of those resources. And gift funds can be used, and a gift is where a family member helps contribute to your home purchase. Those gifts do not need to be seasoned, but they do need to be sourced. So we just got to make sure that the donor has that money in their account, whether that's their brokerage account or a bank account. And a gift letter is usually required for that donor. Not usually, it is required for that donor to complete to show how much they're gifting towards a transaction. So in some cases, especially as first-time buyers, we have some buyers that receive all gift funds for their home purchase, and that is absolutely allowed in home purchasing. Now, for some of our clients, just saving for a home purchase can be challenging. With the cost of goods nowadays, it is very difficult. And for many of us that are just starting on this path towards home ownership, we just maybe are still trying to, pay down some debt, or maybe we just haven't got a chance to, get into our careers where we're able to save as much money. And so, when we design plans for future home buyers, first-time homebuyer assistance programs can be a fantastic resource to help make homeownership more of a near-term goal. So you heard me talk a little bit about CalHFA earlier in tonight's discussion. CalHFA is the California Housing Finance Agency, and it's designed to create that sustainable and affordable homeownership for both moderate and low-income housing households across California. So this is a statewide program. And right now I'm going to kind of share with you some of those resources that are available to you as eligible first-time buyers. The first program available is the My Home Assistance Program. So we talked a little bit about the minimum down payment requirements, and this My Home product would meet those at the conforming limit. So you can put as little as 3% down, have that completely covered under the My Home Assistance Program. Or if you elect an FHA loan, you can get 3.5% of your purchase price for that product. Now, this is a low interest loan that's at 1%. So that's super cheap interest, especially in today's market. And it allows you to fulfill that down payment requirement. It's a low interest rate at 1%, as I mentioned, but it does not require repayment to the state until you either sell your home or if you refinance in the future. So really, really great opportunity. Now, when buying a house, you also have closing costs. So at times, we can not only take advantage of the My Home Assistance Program, but we can add on a program called ZIP, or Zero Interest Program. And it can provide up to 2 to 3% of your loan amount in interest-free assistance. It also does not require repayment until you either sell the home or if you refinance in the future. So really cool opportunities there. The market right now on interest rates, as we talked a little bit about earlier, is a bit volatile right now. So the ZIP Assistance Program is not always available. So I would say as first-time buyers, if we're thinking about utilizing this product, it's probably going to be more centered around the My Home Assistance and then having enough savings to cover our closing costs if we're looking at just using the My Home Assistance. Let me show you an example of what this would look like on a conventional loan for a first-time buyer. So let's say I purchased a home of $450,000. The minimum down payment is 3%, which would be $13,500. And then I would also have those closing costs. So my expected out-of-pocket more than likely is going to be anywhere between $22,000 to $27,000. Now, that may not sound like a lot for many of us joining tonight's class, but it may be a bit of a reach for other clients that are in tonight's class. So the assistance program can provide resources. Like I said, the My Home Assistance can fulfill that 3% down payment requirement and then potentially add the ZIP assistance to offset some of those closing cost requirements as well too. So the program can be a fantastic resource to be able to get clients into homes that much quicker. Now, there's another product that we're really excited about. We've been talking about it in past classes over the last probably 4 or 5 months. In fact, we just released a video on that that'll be on our social channels probably tomorrow or later in the week. It's called the California Dream for All program. Now, it's not available till March 27th, but we're starting to consult with clients on the program because it is going to be a first-come, first-served basis product. There's overall $300 million set aside in the state budget between this year and next year for the program. It allows you to borrow up to 20% of your purchase price or appraised value, whichever is less, in assistance to fulfill your down payment and/or closing cost requirement. This is a very kind of cutting-edge product. It's really unique to the state. I was fortunate enough to be a part of the project team in the development for this, and it's really cool because it's going to make homeownership much more achievable for first-time buyers, but much more affordable. And on average, in designing some of these new products for clients, we've seen savings of anywhere between $400 to $600 a month in monthly payments. So being able to go from just putting a minimum down to being able to put 20% down, creating that huge of a difference. Here's how the program works. So it's 20% no interest paid, and the 20% is not paid back to the state until you either sell the home or if you refinance in the future. Now, there is an exception to refinancing. You will be allowed to refinance one time during the duration of the loan without having to pay back the 20% at that time. So there's some I guess guidelines around that that are still yet to be released. They will be released in the next couple of weeks, but it is not required to be paid back until you sell the home or if you refinance in the future. Now, the next component of the program, there is an equity share or appreciation share with this product. And what that means, it's a 1-for-1 appreciation share. So if we get 20% in assistance from the state will partake in your equity appreciation 20%. So what that means is if I buy my house for $600,000 and I sell my house 7 years from now and it goes up to $650,000, that means it's grown in value by $50,000, right? So at the time of sale, I would pay back to the state my 20% interest free that I've received when I bought my house, plus 20% of that appreciation, which would be basically $10,000. Okay. So there is a bit of a trade-off with this program, but the opportunity for first-time buyers is absolutely huge. So the longer you keep the 20%, the longer that appreciation share would continue. Now, this is not forgivable, so it is a repayment. So they've had products, or we've had products in the past that are forgivable based upon time in the home. This is not like that. It's a 20% share of the equity appreciation there, but there is no kind of time component to it. Now, some of these details of the program are subject to change because it's not set for launch until March 27th. The 20% that's being received in this program can be used all towards your down payment. You can take, use 17% of it towards your down payment, 3% of it towards your closing costs. So you can kind of reconfigure your financing depending on what makes the most sense for you, what you have available to you. Now, I would say, this isn't going to be a situation where you're not going to have any money out of pocket, because as you're going to learn in just a minute, there is minimum out-of-pocket expenses to purchase a home, which is called an earnest money deposit. So we'll talk about that in just a minute. But again, a huge opportunity for a lot of our first-time buyers. Let me show you a quick example before we kind of move into our loan process, and I'll give you a few more characteristics on the program or the guidelines for CalHFA. So let's say I bought a $450,000 house. We've already talked a little bit about what the out-of-pocket expense would be. So let's say we implement this program, and now I'm buying that same $450,000 house. Now I could put $90,000 down, or I have not access to $90,000. And I can use that $90,000, put it all towards the down payment, lower my monthly payment, or I can split some of that up and contribute some towards my down payment and eliminate all my closing costs. So one of the things that we'll do during a home buyer consultation with the client is obviously we're going to run through different payment scenarios, and we can kind of mix and match that product based upon, what that budget goal looks like for you. This product cannot be used with the MyHome or ZIP program. It's a freestanding product, so to speak. So with CalHFA products, on an FHA loan, non-California Dream product, the minimum score is 640. For the California Dream product, it is a minimum score of 680. So it only works and it's only compatible with the conventional loan product. And for the debt to income ratio that we learned a little bit about earlier, it's a maximum debt to income ratio up to 45% if we have less than a 700 credit score, up to 50% if we have a 700 credit score or better. Now, the income qualifications for this program are only based upon the applicant, not the household size. So if I just apply in just my name, that is the only income that's used for the qualifying. And why that's important, because it may be needed to help keep us below the income limits. I'm going to share with you the income limits in the next slide here so you can see what Orange County looks like, in LA and county, or whatever county that you're looking to purchase in. Now, this is only for first-time home buyers. So a first-time home buyer is someone that hasn't owned in the last 3 years. And then this has to be a one-unit property, which can be a single-family home. You can purchase a new construction single-family home, condo, townhouse, even what we call BMR homes or below-market homes are allowed. And manufactured homes can be potentially eligible, but it has to be on land that is owned. Here's the income limits for the program. So it's above basically 150% of the median income for those respective counties. And for those of you that are joining us from other counties, we can share with you the income limits. We have a site devoted to the California Dream product. So you can visit our website at cadreamforallmortgage.com. And that actually has all the income limits. It's linked back for all the income limits across the state. I think we can put them in the chat too, if you like. All right. Any questions on some of the first-time homebuyer assistance programs? I know I gave you a lot of information, and we can certainly circle back to that a little bit later in tonight's discussion. Okay. I'm sure some things will come up. I do want to get us through the buying process now. Actually, we had a question come in. Actually, I take that back. We have our income limits were just posted. So, all right. So if something comes up, you guys have questions, we can definitely circle back with that. I can't tell you how excited I am for the launch of the California Dream product. I think it is a game changer for our local communities to just make homeownership that much more affordable, for sure. So let's talk about this path towards homeownership. Let's talk about the 6 steps of home buying. So we've created this kind of visual tool to help our home buyers understand like what comes next in the buying process. So step 1 is going to be the pre-approval. So that's going to be the output of a consultation with us. And the consultation is a one-on-one session that we get a chance to design your home buying plan. And then the pre-approval comes out of that session. So that shows, well, first of all, it's a certificate that you can present to a seller that shows them that you're eligible for your financing. It's usually good for 60 days, but we can always recertify that pre-approval at any time. Okay. So we have many buyers that have been shopping, unfortunately, for the last couple of years, and now they're kind of, getting back into the market. We can always recertify it. That pre-approval at any time doesn't require them to reapply for their financing. So we keep that application on file for 2 to 3 years. The next step in the process is the fun part. That's the house hunting. That's where you get a chance to kind of get your list of everything you're looking for. And you've probably done some Zillow and Redfin searches, but once you've identified a few properties that really fit, the criteria that you have in that community you want to purchase in, you're going to start going out and looking at those homes. And I would really encourage you to basically connect with a realtor. And realtors are experts in the market. They're going to help find that property for you. They're going to help negotiate. They're going to help set up inspections for you. We have a fantastic network of preferred realtors that we work with. And if you do need that resource, we'd encourage you to, we'll encourage you to get connected with one of them. But they'll be a great resource to help you in the buying process. Now, once we find that house that we love and we want to make an offer, and again, it's a buyer's market right now, so higher probability of acceptance than what we've seen, 7 or 8 months ago. But if that offer gets accepted, then we're going to move to step 3. And that's called entering escrow. So that means a seller has accepted our offer, and it's going to start this timeline from step 3 to step 6, which is usually 30 days. So from the time at acceptance to the time I get my keys to my house, it takes about 30 days. Now, it can be as short as 21 days, but on average, it's about 30 days. I mentioned earlier to you that there's going to be some money required out of pocket, even if you elect the California Dream for All product. That's called an earnest money deposit. And usually that deposit is going to be anywhere between 1% to 3% of your purchase price. Those funds will count towards your out-of-pocket expense if there's any for your home purchase. And that deposit is usually required in the first 2 to 3 days of the acceptance of your contract. Now, once we hear that your contract has been accepted, we're going to give you a call and we're going to schedule you for a follow-up consultation. And that follow-up consultation is where we meet for about 30 to 45 minutes to talk about the design of your financing, go over interest rate options, payment scenarios, out-of-pocket expense, make sure that you feel really comfortable with how your financing is designed. And then we deliver to you your disclosures for the financing we've discussed. Simultaneously, we're going to be ordering your appraisal of your property to make sure that we want to make sure your house is worth what you're buying for it. And that's to protect you as a buyer. And your realtor generally will be ordering inspections for you on your home as well. Now, the earnest money deposit, like I said, is anywhere between 1% to 3%. We have 1% to 2%. Some of our markets, it can be as high as 3%. So let's factor in 1% to 3%. Your realtor will help you on the number of what we're seeing kind of in the market. But that money is held with the title company, and it gets counted towards your total out-of-pocket expense. And that money is protected by what we call is the contingency. So you have the right as a buyer to do your due diligence on a property during your escrow time period. The contingency period is usually anywhere between 14 to 17 days from the start of your contract acceptance. So you're going to have your house appraised during that time period, which we're going to help get ordered. You're going to have your house inspected, and then you're going to get your loan approved, which will help out with, of course, as well as the lender. That usually happens, like I said, in the first 14 to 17 days of your contract. Sometimes it can be short as 10 to 12 days, just depending on how competitive the negotiations are with the seller. Step 4 is going to be processing and underwriting of your loan. That's where we do some of the administrative tasks of your loan, verifying employment, assets. We're basically preparing your financing to go to the underwriting team. And the underwriting team goes through all of your documentation, make sure that it matches the requirements for the underwriting guidelines for the particular program you're applying for. At step 5, an underwriting approval will be issued. And that approval basically says that you're solidified in your financing, everything looks good. At step 5, we're also about 3/4 of the way through the process. So at that time, once we have loan approval, we're going to issue to you a final closing disclosure. And what that disclosure does is it gives you a 3-day cooling off period before we move to the very final stage of the process. Because that cooling off period basically allows you to double check your numbers, make sure you still feel comfortable with the product, and make sure that everything's kind of in alignment with what you expected. So step 6 is going to be the closing of the loan. So after that cooling off period has elapsed, then we're going to sign final loan documents in person with the public notary. Now, all of the disclosures that you receive leading up to step 6 are all e-signature. But step 6 is still a little old school. You do have to sign documents in person with a notary. That process takes about an hour. After you've completed that, then you're going to be required to wire in your final funds for your closing. So if there's any additional funds needed, you'll contribute that. Once those documents are completed, though, they'll be uploaded back to our compliance team. We'll do a final review of everything. If all that checks out, the next day we wire funds for your mortgage and then your assistance program, if you've elected that. That money gets basically balanced out with an escrow officer. He makes sure that all those monies are accounted for, that the seller's receiving the funds they expected. You're contributing what you're supposed to as a buyer. Once those funds get balanced, they release the documents to the county recorder's office to record what would be known as a grant deed, which transfers ownership to you, and then a deed of trust, which is your agreement to repay the loan. So once all those recording confirmations come in, guess what? You become the official owner of the house. You can celebrate. We'll give you a virtual high five and obviously congratulate you on this huge accomplishment. And we always send our clients a little housewarming gift after they get settled into their home. So huge accomplishment, doesn't come with a lot of anxiety and just nervousness and just a lot of emotions that we go through the home buying process. We want to do our best to help guide you through that process. And we really stay connected with our clients, whether it's on email, text, phone. We always have a team member available to help support you during that process, because we understand this is going to be one of the biggest investments you make in your upcoming financial futures. So how do we get started in the process? If it's something that sounds interesting to you and you want to maybe get connected with us, we'd love to be able to do one of those consultations for you and build a home buying plan. That starts with an online application. You can upload proof of your income and asset information, and then we'll meet with you for that video consultation. If you have some follow-up questions, we'd love to be able to get connected with you for an introductory call, because not all of our clients that come to some of these workshops are ready to go, and we understand that. But we want to be a resource and just support for you. So when you are ready to take those next steps in the process, we're here to help guide you. So all the links to schedule either that consultation or introductory call are all found on that slide. I've talked a little bit about the consultations throughout the night. Here's kind of what that looks like. We're going to look at a lot of what we've shared with you in tonight's discussion. So budgeting, looking at affordability, talking a little bit about locations, because that will change eligibility for first-time buyer programs. We'll look at interest rates, payment scenarios, the process. And, if it all goes well, we're going to issue that pre-approval for you so you can start on that path towards finding that home that works for you and your family. And there's some great resources that we also have for you, like our mobile app. So if you want to begin the process, you can do it all via mobile. You can, do calculations. You can follow the progress of your loan all via mobile. You can actually even upload all your documents through mobile. So we try to make sure we're as user-friendly as possible for our clients. Now, as I mentioned earlier, this is an Irvine-based workshop. So we're so grateful and thankful really for the UCI partnership that we have with alumni. So many of you are joining tonight's class because of that, but we also have other partnerships across the country too. So we do a lot on the West Coast. We're starting to expand a bit on the East Coast for some of our classes. So if you have friends, family, maybe coworkers that would love to attend one of these classes, we'd love to be able to help them out and kind of help guide them on that path towards homeownership. So we're going to get to the end of tonight's discussion, and I'm going to open it up for some of the questions we have in the queue right now. But I will tell you, check us out on some of our social channels, especially on what we're posting on Instagram. We like to share a lot of our testimonials, but we're trying to provide good content to our local communities. As things change, updates on the California Dream for All program, we share those with our communities. So, we encourage you to follow us on our social, on Instagram. And then we love what our clients are saying about us. So, check out some of our reviews, some of our testimonials, a lot of which have come from, graduated members of our classes over the last 8 years on some of our Google reviews. We're really proud of what our local community and clients say about us. Okay, so let's go ahead and open it up for a little Q&A, and we'll hopefully answer some of the questions that you guys have. So first question was, how long is the 20% CalHFA Dream Program expected to last for? So as I mentioned, the program has $300 million in the budget. I believe $100 million is being allocated towards this year. It is a first come, first served basis for that product. So we cannot reserve the funds for that product until you have an accepted offer for a home. So the first reservations will open up on March 27th. So our goal is to, have clients pre-approved ahead of that, start the home search, and then hopefully once we have the accepted offer, we can have those clients reserved for those funds. And then another question is, do your fees come out of the buyer's or seller's fund? So good question. So when you have closing costs, like we talked about origination charges, those are on the buyer's side of the equation. So any of the charges that American Pacific Mortgage or any other lender has, those are usually buyer paid. Now at times, especially because it is a buyer's market, some sellers will provide what we call a credit towards closing costs. And some of those credits can be used to help offset things like lender closing costs. Okay, good questions. All right, we have quite a few of you still in class. So I want to see, is there any other questions I can help answer for you on tonight's workshop? Okay, So good. So another great question. So what are consultations? What do they cost to meet with this? So there's no cost. And I should have probably mentioned that. That's a free consultation we do with our clients. So, whether you're looking to purchase this year or next year, it's just a service we provide to our clients. So there is no cost for that. But thank you for that question, because I should probably mention that. All right. Any other questions before we wrap up tonight's class? All right. I think we're there. So thank you so much for joining tonight's class. If you do have any follow-up questions that didn't get answered tonight, we'll definitely get a follow-up to you. Actually, we had one other question that came in. Let me just answer this really quick. Under California Dream, if the value decreases, do we still have to pay the 20% appreciation agreement? So no, you would not have to pay 20% because if the home goes down in value. However, the 20% down payment, the no interest, would still be owed. So good question. All right. Thank you so much for attending tonight's class. Again, if you have friends, family, coworkers that likes to attend any future classes we have, please check out mortgageeducate.com, and then we'll make sure we send you all the presentation material tomorrow. Have a good night.